All right, welcome everybody. It is Tuesday at 6:03, so we're 3 minutes late, just because Serena and I were cleaning up last-minute files from last-minute people submitting stuff. So, today is October 15th. This is the due date for extended 1040s and 1120s, not to be confused with 1120s. Um, and for us here, my office is in Georgia, so we actually got everything extended because of the Hurricane Helene to May 1st. But still, we don't want to wait longer than we have to. So definitely want to get things in as soon and as quickly as possible, which for most people is, you know, now we only have a couple stragglers, to be honest. I always freak out when it comes to deadlines. It's like, is everything ready? How many people are on our pending list? Because a lot of the biggest challenge in what it is that we do is people send us stuff and then we're like, hey, we need more stuff. And they say, okay, I'll get it to you. And then 3 weeks go by. You know, so it's and I don't blame clients or I mean people get busy. That's why they hire us in the first place. But it does create challenges when we come up against deadlines. So that's what we've been doing for the past couple weeks, trying to get stuff in from clients. But this is office hours, so we do our weekly Q&A here, and um, this WhatsApp thing for 8 hours. Okay, and this is where we answer questions. So let's dive in. I'm gonna go ahead and skip the bio stuff. Um, you know, I've been in the tax game for a long time. I save people millions of dollars. That's really the upshot. All right. Quality of our questions determines the quality of our life. It's always a great quote. So, what is the problem with overpaying on your taxes? And this drives me nuts. So, there was a client we were actually dealing with today. And, this is like 2 or 3 years running now. It's like, okay, if we do these things, save you a bunch of money. It's like, yeah, I don't want to do it. Why? you know? But it just doesn't want to. And it kills me inside because it's a waste of life, as far as I'm concerned. A day that you go to work, you provide value to the world in doing whatever it is that you do. You provide a good or a service, mostly services these days, and you earn money and you come home and you take that money, you hand it over to the government. To me, that is a day you did not work for yourself. It's a day you worked for the government. You didn't work for your family. You didn't work for your community. You just handed it over to people who are not going to do a good job with your money. And whatever your feelings are about, political persuasions or whatever, I think we can all agree they don't do a great job with the money. Uh, even if they spend half of it on things you like, the other half is on things you don't like. And which half that is, it's up to you. But trillions of dollars are just uh, what's the word? Wasted.
Donate it.
Donate. I mean, it's just horrendous. So I want to keep that amount of that money in your pocket, and I want to keep it out of the government's pocket. And that translates to 74 days a year that um, that you could get back for yourself. And whether you spend that time working for yourself or going on vacations or you know cruising the Riviera, whatever it is you want to do is fine. It's still a better use than handing it over to the feds or the state government even. So I know this is Q&A, but I have the answer to all tax questions. The answer is
Drum roll. Ding.
the answer is it depends.
It depends.
It depends. And people say, what does it depend on? And my answer is, well, it depends on what you're talking about. So part of what we do here on these Q&As is Serena ask me questions. And I'll always say, well, almost always say it depends. And then I'll kind of go through, the scenario of whatever the question is, and we'll talk about the things it depends on and how, well, if it's scenario A, then this happens. Scenario B, then that happens. And we'll walk through some of that, which is why some of my answers take a long time. Uh, but yeah, that's the basic idea. Everything depends on facts and circumstances. What is true for you is not necessarily true for somebody else. That's why we file tax returns. because the IRS, they get reports from third parties. You get a W-2. Whoever issued the W-2 sends you a copy, sends the IRS a copy. Whoever issued you a 1099 sends you a copy, sends the IRS a copy. But the IRS does not actually know what to do with that, really. And so the tax return is your opportunity to tell the government what happened in relation to these money flows. Are they taxable? Are they not taxable? Were they taxable? And then they had, associated expenses, which reduced the total income that was subject to tax. And all these different, caveats and adjustments and things. That's what the tax return is. It's telling the story of the year in numbers. Um, and yeah, so everything depends. All right. Since we got a little bit of a late start, let's just jump into it. Serena, what do we got as far as questions
So,
goes?
yeah, so we have a late filing question.
Yeah.
The client wants to know what happens if I don't file my taxes on time and the IRS owes me money. Will I still be penalized?
If the IRS owes you money, no, there is no penalty for late filing. So the real cutoff for a late filing, if the IRS owes you money, is 3 years. So in 2020, in tax year 2021, you know, those tax returns were due April 15th of 2022. All right, that's the original, due date. And if you did not file them and the IRS owed you money, then when you do file, they will pay out whatever the refund is, and they will pay you interest, determined by the statutory rates. And if you wait past 3 years past that original due date, so for tax year 2021, the original due date's April 15th, 2022. 3 years past that is April 15th, 2025. So if you file a 2021 tax return past April 15th, 2025, then you'll get a nice letter in the mail, and the IRS will say, "Oh, we've processed your tax return. You were due a refund, but so sad, you waited past 3 years, and so the statute of limitations has elapsed. We don't have to pay you anything." And that is what they will absolutely do. So, yeah, if you're getting refunds, you never have to worry about due dates except for the 3-year date, so that because after that they just won't pay you. So the statute of limitations is funny. You have 3 years to go back on them and get money out of them, and they have 10 years to go back on you and get money out of you. So guess who makes the rules? And people get confused by that 10-year thing because it's like, oh, I always heard you're supposed to keep 7 years of tax returns. It's like, well, sort of. The way it works is that the statute of limitations federally, and most states follow this, California does not, as a notable exception. Uh, statute of limitations federally is 10 years. So and I've seen this happen, where the IRS will send a notice on some issue that's past 10 years old. And some people, without knowing the relevant regulations, they'll just go ahead and pay whatever the issue is. And of course, there was whatever the original issue is plus interest and penalties over all those years. So the interest can often add up to be more than the original tax issue when you talk about that period of time. But there is a statute of limitations. However, it's what's called an affirmative defense, meaning that if the IRS contacts you for something that's past 10 years old, you have to tell them, hey, this is past statute of limitations, and then they'll drop it. But they won't drop it ahead of time. So that's the actual law. By policy, the IRS only goes back 7 years. So that's an internal rule that they may or may not follow. And in reality, they really only go back 2 to 3 years. That's the real audit cycle. So we're filing 2023s now. 2021s are in the audit window. 2020s are in the audit window. The old stuff, 2019 and earlier, they really don't pay attention to. If you played some shenanigans in 2019 and you haven't gotten a letter by now, you're 98% confident that you're not going to get anything about it. That changes slightly if there is an issue in a later year, and they can then expand the scope back to those previous years. But in general, if you if you slid by now, you're okay. So that's where that 7 years comes from. It's from that internal policy of that IRS. So like as tax preparers, we're required to keep records for 10 years because that's the actual statute of limitations. And right now we're up to 2013, I guess, as far as that applicable coverage window. Although we have, I mean, these days there's no real reason to delete stuff. It's not like we have filing cabinets anymore. Everything's digital, so it's all just stays on storage, and storage is really really cheap now. So we have some clients going back way back, but by and large, 10 years is the actual window. So if you do owe money, then there's a couple different dates to keep in mind. So one is the original filing date, which for 1040 is April 15th. And that is the date to get your payment in and to get your paperwork in. So there's two different things: the money and then the paperwork. If if you file an extension, that is not an extension to file, or sorry, that is not an extension to pay. It is only an extension to file paperwork. They still want their money up front. And where the extension comes in is like if you don't file and you don't pay them, then there are failure to file penalties in addition to um, failure to pay issues. So there's multiple different things going on, and the failure to file penalties can be up to 25%, which is significant. So let's just take this year for example. So 2023 taxes were due April 15th, 2024. 2023 tax returns were due April 15th, 2024. You can file form 4868. That's the automatic 6-month extension to extend the paperwork to October 15th of 2024, which is today. And people usually do that. That's usually not a problem. Most people who file extensions also have not paid. So that's an issue. Interest is accruing. Even if you are able to avoid penalties by filing extensions, you're still paying interest. And some people don't care, but that's kind of where it is. If you go past April, or if you go past the extension deadline, then you have a failure to file issue, unless you have a hurricane or a natural disaster of some sort. So we have Hurricane Helene, which affected the Southeast, and basically Georgia, Alabama, South Carolina, North Carolina, and I think Tennessee was included in it, where everybody got extensions to May 1st of 2025 to get their paperwork in. Again, does not extend the time to pay, but does extend the time to get the paperwork in. And since Tax Sherpa is located in Georgia and we're under this disaster exemption for us and all of our clients, we're actually subject to this extension, this automatic disaster extension, which is, handy. So so people who are freaking out don't need to if they're one of our clients. If you are not in a disaster zone and your tax preparer is not in a disaster zone, then yeah, October 15th is the deadline to get extended tax returns in if you filed an extension in April and you owe money. So there's a whole bunch of little flowchart things and all that I just said. But basically it's only an issue if you owe money. That's the takeaway. So
I'm laughing, because I'm thinking how many people are going to be like, I don't know about that one. But it's true.
yeah. Oh, the other thing
Yep, yep.
is that if you wait past a year and you do a refund and then you file it, the IRS will pay you interest, like I said. However, that interest is taxable income. So the IRS will send you a 1099 in January of the following year saying, hey, we paid you whatever number of dollars of interest. So don't freak out when you get that in the following January. But people often get surprised by that.
Alrighty. So Neil, we have a Augusta rule question.
Yep.
A client wants to know, how can I use the Augusta rule to rent my home to my business without paying taxes on the rental income?
Yeah. Carefully. So the Augusta rule is comes under, it's one of my favorites. It comes under section 280 AG subparagraph 2 of the Internal Revenue Code, which is Title 26 of the U.S. Code. So what happened was in one of the revenue acts, this one was in 1976, this language appeared out of nowhere. And it's just, this is lobbyists at work. So what it says is that if you rent your primary dwelling for fewer than 15 days during the calendar year, then that income is exempt from your taxable gross income. Additionally, subparagraph 1 says that um, the expenses related to that rental are also not deductible, which is fair. So if you rent out your primary dwelling for 14 days or less, then you don't declare the income and you don't declare the associated expenses. So it's just a wash. So it's tax-free money in your pocket. So that's actually the Augusta rule. Where we elevate that into a more powerful strategy is that well, and let me back up there for a second. So it's called the Augusta rule because it comes from Augusta, Georgia. The rich guys who live around the golf course, who for the Masters tournament, they wanted to rent out their houses during the golf tournament and not pay taxes. So that got slipped in there in 1976. And then I've actually read the legislative history of it because they keep notes of like committee meetings and stuff. And one day it just appears and there's no discussion of it and no one ever mentions it again, which is hilarious. But but so that's the actual Augusta rule. So if you rent out, let's say you live around the Augusta National Golf Course, and you decide, hey, a whole bunch of people are coming to town. I want to rent out my house for 2 weeks. Great. I don't have to pay taxes on it. So that's element one. Element two is how do we make this more powerful? And here what we do is uh, we create a rental agreement between your business and you. So you're going to rent out your primary dwelling to your business. So then it becomes a business deduction. And here's where people screw it up. So by taking a deduction on one side and not declaring income on the other side because it's exempt from that income, then you're able to double dip. So you get a two times effect on the um, on the tax strategy. However, where people screw it up is they don't have a business purpose for the rental, and you know, so the way we encourage our clients to do it is to actually have a business management meeting, and this is what we call the summit strategy sessions. So what this does is it helps business owners actually have a management meeting, which they should be doing anyway and aren't. So take the opportunity to take the tax strategy and build yourself a better business. And we have a step-by-step process where you review your books on a month-over-month basis and a quarter-over-quarter basis and a year-over-year basis. And you say, okay, how are things going? And basically, business is not that complicated in the sense that you want to improve on what is going right and you want to reduce what is going wrong. And at any given time, the just average scope of attention is that people can do like three things. And if it's more than that, then things aren't getting done. So, um, that's fundamentally all it is. The summit strategy session is a guided structure to help you actually take the time and identify what is going right and what is going wrong in your business. And if you do that over time, you'll sequentially, give a little nudge, say we're doing this better, do that better, and reduce this thing that's not working, and you create a bigger and bigger spread over time. And so, you know, 2 years down the road, you'll have a much more effective business than if you are just doing like most small business people do, which is just getting stuck in the grind. And you wake up and you look at your bank account and says, "Hey, there's money in there, great," or "Hey, there's not money in there, crap." That's sort of like the extent of most business owners' strategic planning. So if you can do better than that, you will outcompete your competition and you will make more money. And in the end, you will actually end up paying more taxes because you'll have a much more profitable business over time. But this kind of goes back for a second to like why do tax strategies exist? Why do deductions exist and all this kind of thing? And these are all carrots and sticks created by the government, and they are to encourage you to do things that they want you to do, and discourage you from doing things they don't want you to do. And fundamentally, all business deductions come down to the fact that they want to encourage, business activity in America because that grows the economy overall and is better for the country as a whole. So that's the underlying principle of all tax deductions. Now, there are, you know, there are many ways to skin that cat, I guess, but this is one of those things where it's like if you have a business purpose, this is a uh, way to implement that business purpose and get a tax deduction at the same time. So It's really powerful if you do it right, and not just on the tax side, but on the making more money side. So that's the key thing to do, so that you don't screw up the strategy, basically.
Right. And we see this being done, the Augusta plan, being done by other accountants, all wrong.
Yeah, well, there's a lot of people who just wave their hand in the air,
Mhm.
which I'd rather have them do it right and actually document the business purpose by going through and doing, enacting the business purpose in reality. So yeah, just do the things and then you'll be good.
Alrighty. It looks like we have a salary question, Neil. So, someone asks, when is a good time to pay myself a salary from my business for tax advantages and compliances?
Yeah. So, well, it depends on what kind of business you have and what the tax status is. Salary comes up when you have S corporations primarily. So, there's kind of three basic businesses that we see most of. There's in the U.S. there are 40 million small businesses that file out a Schedule C, a 1065, or an 1120S. So Schedule C is just a sole proprietorship. It's you personally enacting a business. Even if you have an LLC for tax purposes, it's still you. And so it gets included as part of your 1040. So usually you don't need a salary from a Schedule C because the the net profit from the Schedule C business is subject to self-employment tax already. And self-employment tax is just the 1040 version of payroll taxes that goes to Social Security and Medicare. So since you're already paying that on the net profit, there's no need to take a salary. It's just because it's still it's you paying you, right? Now that can so it depends. It depends on the total level of income, for yourself personally, because this gets into the qualified business income deduction, where there are times if you have a really profitable Schedule C, and we see this every now and then, uh, even though the payroll tax portion is the same, if you get above the qualified business income deduction threshold, then it can be advantageous to take a salary because that will boost your qualified business income deduction. So there's a lot of math that goes into that, but that's kind of an edge case we don't see a whole lot. If you have a 1065, same story as a Schedule C. The net profit is generally subject to self-employment tax, and so you don't need a salary. Some people get guaranteed payments, which is a replacement for salary from a partnership. And we had one client who had there was this a very annoying fight where so guaranteed payments from a partnership are it's exactly like it sounds. They're guaranteed payments. You get this no matter what. And so it's a replacement for the salary, usually going towards, one of the partners. I think always going towards one of the partners. And it could be multiple. And it's saying that, hey, I'm getting paid for showing up. That's it. And over and above that, I might have profits, I might have losses. Who knows? Depends on how business goes. But I'm guaranteed this amount. So uh, so generally, you're not going to see salary on that. Again, like Schedule Cs, you can run into qualified business income deduction issues if the income is high. Where we see a lot of salary issues is on S corporations. So the big difference between an S corporation and then the other two, the Schedule C and the 1065 partnership, is that the net profit is not subject to self-employment tax, meaning that you do not pay 15.3% on the net profit of an S corporation, which is why most of the time, the vast majority of the time, an S corporation is going to be the most advantageous structure for your business. So, because of this advantage, there is an offsetting rule called reasonable compensation, where the government has decreed that you are supposed to pay yourself a reasonable compensation for the work that you do for your company, and that applies to first money out. So, I'm not going to do a whole thing on reasonable compensation, but
Mhm.
basically, you know, if you take money out of your company the first chunk of it is supposed to go towards W-2, and you're going to pay payroll tax on that, which is again that 15.3% for Social Security and Medicare, and the rest comes through as profit. And so you do first one, then the other. As far as when you do that, a lot of times, for business owners, we'll look at quarterly. Some do monthly. Some will run a payroll like every 2 weeks, just like any other employee. But it depends on the scope of your business. Some people will do once a year if they don't need the cash flow from the business. They have other things that they're living on. So um, it really depends on your personal cash situation, how much money you need out of the business, how much the business is making, what is reasonable for you, because like there again, that's a whole hour-long conversation unto itself as to determine what actually defines reasonable, because it's not defined anywhere, but there's some court history you can look back on, and then figuring out how much the business can actually pay. If the business isn't making any money, then you don't need to take a salary because there's nothing to take out. So, um, so all these factors go into the timing as well as the amount. And then, assuming that there is money to pay on the salary, then the questions become, so, well, how does this affect qualified business income deductions? How does this affect retirement planning? Because once you have a W-2, then you have earned income, and then you can contribute to retirement plans. So it's a complicated subject. But as far as how often, most frequently, I'd say the most common cycle that we see is quarterly. Second most common would be monthly, and third most common would actually be annual. Very few S corp owners will pay themselves biweekly, but some do. So so it depends.
Right? It depends. Um, there was a case where Neil, where we had that client, it was like 200,000 of salary, and they made 200,000.
Yeah, yeah, that was an extreme one that we don't see very often. But yeah, we
Right.
had to fix that. That was a whole pain, but saved them. What was it, like $16,000 on payroll taxes?
Yep.
So yeah, it's you wanna do, like, the whole thing about tax strategy is, like, you want to follow the rules in a way that makes sense and advantages you as much as possible. That's kind of like across the board. So um, yeah, you gotta just pay attention to what you're doing. Um, yeah,
Or
this
fine.
this does bring up one other issue actually.
Mhm.
So a lot of times, we'll talk to new clients and we'll say, it's like, oh, you have this LLC that you've been filing Schedule C on for 10 years or whatever. It's like, has anybody ever talked to you about converting it to an S corporation? And they'll say something like, yeah, I talked to my previous tax person about that, and he said that that only makes sense if I'm making like 200 grand or more. And I've heard all kinds of numbers. Some people say 50, some people say 30, some people say 100, some people say 200, whatever. And then under that, it doesn't make sense. It's like, that is such nonsense. So it makes sense at any number. The thing about the S corporation and like where it makes sense is that, you know one, it creates more work, for the accountant, because it's a whole other tax return and there's all these other issues that go along with it, and uh, so it increases the filing complexity, and then and then in general the annual fees are the same in most states. In some states it does change, but it's really just accountants being lazy, to be honest. It's like, well, I don't want to do this, and if you do that, then I have to charge you more, and then it's not worth it. And it's like, well, it's like it it is more work, yes, but it allows for more powerful tax strategies. So it almost always makes sense. There's only a couple situations, and those situations are usually around the states. So like we've got one client in DC, and you know, we have left that company as a Schedule C company only because the state would charge an extra 8.5% on the net income because of just because they want to, basically, and they don't do that as a Schedule C. So, you know, there's edge cases like that where it's better to stay a Schedule C, but in general, it's going to pay to convert to an S corp. 80 or 92% of the time.
All right. And speaking about the S corp, Neil, I have an
Yeah.
S corp question.
Okay.
So someone asks, if my S corporation has a loss, do I still need to report it on my personal tax return after filing my Form 1120-S?
Yes. So that was the easy one. But so so the S corporation files its own tax return. At the bottom of the tax return, there's a net income or net loss, and then whatever that number is gets split up amongst the owners on what's called Schedule K1. It's just the reporting statement from the company to the owners, and it's like it's like the company owner version of a W-2. So if it's a negative and it's a loss, then that's going to flow through into your personal tax return. Now, where it gets tricky is that that loss may or may not be deductible to you personally, depending on how much investment you have in the company. And this is a concept that's called basis. So you have to have enough basis, enough investment in the company in order to absorb that loss. If you don't, then you suspend that loss. It carries forward to the following year, and it keeps carrying forward either until you have enough investment or until you have uh, enough profit to offset it. So um, so where people get tripped up by this is with debt. So if an S corporation borrows a bunch of money, spends it, and creates a net loss, and and well, basically that does not increase your investment in the company because that's a company issue. And so we saw one case this past year where that this is what happened. So the owner started the company, put I don't know 15 grand into it, and then got this loan from whoever and spent it all, right, and created a huge loss. And he had $100,000 loss, and it's like, well, why don't I get $100,000 loss on my taxes? Because you only put in 15. That's why. So that basis limitation limits how much you can deduct against other income. So yeah, I mean, you do have to include it, whether it's deductible or not, and how it affects your other things depends on the situation.
So another it depends question.
Yeah, but yeah, do include it for sure.
Okay. Understood. So we have a tax planning question.
Okay.
So someone wants to know what strategies can I use for year-end tax planning to minimize my business tax liability?
Well, we had a whole workshop on that a couple weeks ago, or I guess it was last.
Yeah. Mhm.
I went through 13 different strategies. Um, so there's kind of a couple different buckets. So bucket number one are deduction strategies. Like the Augusta plan that we talked about, or the Summit Strategy Sessions, which is the better version. Um, there are accountable reimbursement plans. An accountable plan is like if you ever worked for a company and you gave them a receipt and they reimbursed you, that's an accountable plan. So it's a reimbursing of the employees or the owners for money they spent personally that was attributable to business purposes. So, for example, if you I don't know, if you used your personal car for business stuff and you document that, then the business can reimburse you for that mileage and or not and or the actual expenses that you incur. So there's a whole lot under that. We've got a whole giant list of things that we go through with clients. Another reimbursement strategy that applies to some people are Section 127 plans. So this is educational plans. So under I think it was the CARES Act, they added student loans into this. So if you have a student loan, you can potentially reimburse up to $5,250, for employees on that. And then there are medical reimbursement plans, which work similarly, for out-of-pocket medical expenses. So that can be pretty powerful if you have medical expenses, which a lot of people do. Other deduction strategies. So the one that everybody knows about is year-end spending, and this I caution people to be careful with. So this is me saying be careful with year-end spending, because if you're cash basis, which most companies are, meaning that we're not talking about like long-term accruals and discounting to present value and all that kind of stuff. We're just saying, okay, cash in, cash out. That's what I'm booking as revenue, and that's what I'm booking as expense. So if I spend a whole bunch of money at the end of the year, I have no net profit and I don't have to worry about anything. that is true as far as it goes. Uh, However, people go nuts, and I've seen people go nuts, and they spend, spend, spend. They say, "Hey, it's a write-off, right?" It's like, well, yeah, but one, it's got to be legit, right? You have to have an actual business purpose. That's usually actually not that hard to justify. But if you're spending money just for a tax deduction, that doesn't make any sense because let's say you're in a higher tax rate, and between state and federal, you're paying 40%. So I spend $1,000 on a thing, and I get effectively $400 off on my taxes. I still spent 600. Now 600 is less than 1,000. Yes, great, but you still spent the 1,000. So only do it if it actually makes sense for your business. So don't spend just to spend, thinking that it's going to pay for itself in some way. Now, the supercharger to that whole thing of year-end spending is debt. So if you buy something that you can finance, you get the uh, depreciation on the whole amount. And depending on what type of thing it is, you might get a huge percentage, might be 60%. Um, and that is attractive, right? So if I you know, let's use the classic example. I buy an SUV that weighs over 6,000 pounds. That qualifies it as commercial, um, under various guidelines, and therefore I can do a Section 179. Section 179. Man, I'm not going to go into the difference between 179 and bonus depreciation, but so I could basically write the whole thing, but I didn't have to pay cash for it because I financed it, right? So I put $10,000 down, and I got an $80,000 truck. Let's just say. So I get an $80,000 deduction for the 10 grand, right? Now we're talking in terms of spending that's actually exceeding the cash outlay on the percentage basis. So if I get 40% off on the 80,000, right? Now what is that? $32,000. So I spend 10 in cash. I get 32,000 back on my taxes. That's a positive 22. Caveat: you still owe the 70 on the note, and you're still going to have those payments. So there's that. And you can get yourself into trouble in a hurry by doing that if it doesn't have a business purpose. Meaning that if that truck is not generating additional income, then you just have increased your payments for you know I mean, you can make a time value of money argument to it, but it generally is not going to pay very well. So, if that truck means you can go do more jobs, it's like, oh, I can hire another crew of, if I'm a landscaper and I can hire another crew to go out and make more money, then yeah, that makes a whole lot of sense. But if it's just I want a new truck, then okay, but you're still not really helping yourself on the whole because you got to pay that money and plus the interest for the car note or the lease or whatever it is you're doing. So that's one that can get people into trouble sometimes because they get all excited about the year-end spending. So, but those are all deductions. So that's reducing the net income. So you have revenue, you have expenses, and you have net income. So deductions create more expenses and reduce net income when all said and done, and that's going to reduce your tax liability. So that's bucket number one. Bucket number two is going to be what did I put it under? I think actually, sorry, that's actually so deductions is actually bucket number two. Bucket number one was business structure, S corp, C corp, partnership, Schedule C, that all that stuff. Bucket number three now is salary optimization. So once you've reduced your net income as much as possible, then you start to have these conversations around salary, like we were talking about before, and we say, okay, what can we defend as reasonable? And because most of these are going to be under S corporations, what can we defend as reasonable? What can we uh, maximize our qualified business income deduction for? Because the QBI is up to a 20% discount on your taxes, which is huge, right? So we were talking to a client the other day who's out in Vegas, and he makes $1 million a year basically. And by structuring his compensation correctly, we're able to get enormous qualified business income deductions for him, and it saves him, just that one thing alone saves him tens of thousands of dollars every year. So getting that math right is really critical if you're in a higher income scenario. Uh, once you have the uh, once you have the compensation structured correctly, and maybe it is a schedule C and you don't have to worry about it, but either way, then you move on to the retirement planning. And is that's going to, there's going to be a lot of math involved, and depends on what else you have going on. But generally, a 401k is going to be the most efficient retirement planning strategy. And the reason for that is because you get an employer contribution and an employee contribution. Most of the other plans, they only have one or the other. And so that limits your flexibility. But the 401k, you can do both. And you can, in 2024, you can put up to $69,000 into a 401k. And you get a bonus if you're over the age of 50, up to $10,000 more. So that can be really powerful. But it depends on your earned income for the year. So, you have to take that into consideration. And that comes from the compensation optimization. So that's bucket 4. Bucket 5 is then what I call the exotics. And the exotics come in different flavors. And I call them that because they require third parties. So all the stuff I said before, buckets 1, 2, 3, 4, that's all internal to you and your business. And so you have complete control over all those things. In bucket 5, we start to bring in outside parties, and it makes it more complicated. There's a lot more back and forth, all this kind of stuff. But there are lots of strategies. There are strategies for purchasing tax credits. There's a whole secondary market out there of people buying and selling tax credits in order to create, lower tax liabilities. So they're basically selling money at a discount. So uh, people often get confused by the difference between deductions and credits. Deductions reduces income, credits reduces tax. So the tax is assessed after, once all the income is documented, and it says, okay, your adjusted gross income is this, your standard deduction is that, your qualified business income deduction is some other number, and then you subtract those, and you get to taxable income. And then that taxable income will be assessed a tax depending on your filing status, because different filing statuses have different brackets as far as which money gets taxed at 35%, which money gets taxed at 22%, and so on. So so tax credits come in after the tax calculation has been done. It says, okay, my tax liability is $20,000, but I have a tax credit of $7,500. So my tax goes from 20 to 12.5. And so the 7,500 there would be like an electric vehicle, for example. So, a tax credit is going to reduce your tax dollar for dollar. And so in the accounting world, there are people who buy and sell these things, and there's different credits for different things. There's tax credits that are sold for movie productions. There's ones that are for one we deal with a lot is the Indian tribal credits for energy projects. There's electric vehicles. There's solar projects. Solar's been big recently. Solar's a little bit limited in weird ways, but they keep thinking Congress is going to fix it, but they haven't so far. So that's one of the exotics. Another exotic is charitable deductions. There are strategies for getting huge charitable deductions, where effectively you're levering up on charity, and that can be really powerful, and that creates a Schedule A deduction of a big number, and then that decreases your taxable income. There are strategies for buying into different kinds of partnerships that will generate losses for you. There are strategies for insurance where you create like private marketplace insurance, not health insurance, but other kinds of business insurance that you can't buy other places, and that can reduce your taxable income. So, the exotics bucket, it's exotic because it requires third parties and because it's kind of a grab bag of different stuff. So they don't all fit neatly into a bucket like the other ones. But yeah, so that's kind of the 5 collections of strategies. And, that is also the order that I recommend people look at them in. So, you want to address your business structure first, get your net income as low as possible, and then from there, figure out what the right compensation optimization is. think about what you want to do for retirement. Some people are pro, some people are for it, some people are against it. Some people are for it but can't afford it, and all these different considerations. And once you settle your individual situation, then you go out and you say, okay, what else can we do in the marketplace? And that's only going to apply in higher income scenarios, anyways, because all these things come with big price tags in the starting in the five figures. So if you don't have big tax bills, then those exact things aren't going to apply to you anyway. And ideally, we can get everything done and get you under that threshold where you need those things purely internally by just doing things in the right way, in a more tax efficient way. But yeah, so that's the basic rundown on year-end tax strategies that you can implement. I don't know if that was
All
too much
right.
or not.
No, it's fine. It's fine. But they could get all this information from the Explorer group or the Navigator group, right? Or
Yes.
the Navigator group.
So I'm behind on repost or posting that recording from that workshop that we had, but that will be in both the Explorers and the Navigators group. So look for that. I meant to get it out Sunday, but it's been a crazy weekend. But craziness should end tonight, and then I'll be able to get to things like uploading recordings.
Okay, alrighty. So, Neil, question for you on the corp side. So, someone wants to know what's the difference, like tax wise, for the C corp versus the S corp.
Yeah, so a C corp is a standalone entity, meaning that it pays its own taxes. So federally, currently at least, C corps pay 21%, and then states depends. It could be zero, it could
Mhm.
be 13, could be whatever. It just depends on what state you're in. So that's that is attractive in some ways because it's very straightforward. And if you have a company where you are getting outside investment, almost always they want it to be a C corporation, and it's because of that standalone feature. So C corps have disadvantages too, in that most people don't use them because the C corp flat rate, even though it's only 21%, when compared to personal income, which has a graduated rate, first at 0, then 10, then 12, then 22, then 24, then 32, 35, 37, the average of that ends up being under 21% for most people. So, um, and then that's not even a factor again the dividend on top of that if you want to take money out. So overall, most people will end up paying less on a pass through like an S corporation or a partnership than they will as a C corporation. But the advantage of C corporations is its simplicity and the fact that it isn't a pass through. So it doesn't affect all the owners individually. So when you go out and buy a share of stock on the stock exchange, those are all C corporations. All right, there's a slight exception that there are master limited partnerships that do trade publicly. But aside from those, so except for that depends. Most of them are C corporations in that. So if you buy a share of Tesla, you buy a share of IBM, you buy a share of Edison Power, you buy a share of any of these things, you might get a dividend, and that creates personal income. But the company itself, their profit and their losses does not affect you personally. So if you're raising outside money, most investors will demand that you be a C corporation because they don't want to deal with having 100 different investments and having 100 different K1s and waiting for 100 different accountants out there to get their paperwork together in order for them to be able to file their own taxes. So that separation can be advantageous in those kind of scenarios. But if you're looking for tax efficiency, generally a pass through is going to be more efficient, and it's because of that graduated rate versus the flat rate. So um, uh, so S corporations, partnerships, Schedule Cs, they all pass through income to the owners. And then the owner is going to include that as part of their overall income. And then they're going to pay their graduated rate depending on what the total income is for the year from all sources. So that's the basic difference: standalone versus pass through and incorporated in the owners. And you know, we could get into how the rates differ and dividends and things like that, but it's probably beyond the 7 minutes we have left. But did that answer your question? That
Yep. That
That's the
did.
fundamental difference.
Yep.
Okay. All right. Last one. What do we got?
So last one would be the reimbursement plan.
Okay.
So someone wants to know how does that process work, but I don't know if we have enough time for that question.
Yeah. I mean, um,
Short
I'll,
version, maybe.
I'll give you the super short version. So first, you want to have a plan. It's a written document that has certain guidelines in it as far as like how and when the company reimburses things. Technically, you don't actually need a written plan, but it's a good practice too. So then you have to determine what is reimbursable. And so you want to look at the expenses that you're paying for personally and saying, is this a business expense? If yes, how much of it is a business expense? Because there are things like, for example, cars. Cars get complicated because, well, it's complicated. But let's say I have a lease payment, right? Lease payment is $500, which I think is like the average lease nowadays in America. Um, so So I pay $500 a month, but I use my car for business as well as for personal purposes. And then, uh, so let's just say 70/30, 70 personal, 30% business. That would mean 150 of that is potentially reimbursable. And so I might take a reimbursement of $150 a month for that business use of my car. Now, whole lot of caveats that go along there. You got to keep mileage or records so that you can actually track what is it 30%, is it 50%, is it 48.2%, whatever the number is. So there's that element, and then there's the commute element. So your daily commute is not deductible, and this is across the board. So the law recognizes that you have a home, you sleep somewhere, and you work somewhere, and presumably those are two different places. You don't work from your bed in most cases. So that initial commute from your home to your work is not deductible, and then from your work back to your home at the end of the day is not deductible. All business travel after you get to work is deductible. So there's a whole strategy around implementing an administrative home office so that the commute becomes from your bedroom to your home office, and then everything after that becomes business mileage. Similar kind of thing is often done with the mailbox rentals. Like if you get one nearby, just stop off there every day. That establishes your initial commute. From there onwards, everything becomes business, and then you stop there at the end of the day and then go home. So that limits the so-called waste from your commute and maximizes your business mileage. If you didn't have any of those things established and you went from home and you went to a business meeting 50 miles away and then came home, that 50 miles each way is not a deduction. It's not a business use because that's a commute, because that's the first place that you're going for business purposes. So, you have to be mindful of these things and, ideally get some expert guidance on how to do all those things. So, that's one of the more complicated ones. But, in general, if I have a cell phone and I use it for personal and for business, I got a portion, how much do I use for business, how much do I use for personal, and then create a reimbursement from my company for the personal funds I laid out already on the business use portion. So it's all about determining what I spent that is business use, and then getting that number dialed in and then taking the reimbursement from the company. But that's the basic process.
And we have 3 minutes.
And we got 3 minutes. Uh, yeah, I think that's going to be it for today. So normally I have like a next steps thing, but I realized I didn't change it from the workshop that we had, which we already had. So this link is not going to help you out because, well, the event is past. But basically, come back next week. We will do this all again, and I will update this slide for next week so that I'll have a more actionable next step for you to do. Um, we still have a course coming out. It's coming, I'm told. It's still waiting, but yeah, that's going to be on kind of dialing in those first couple strategies that we talked about, like with the buckets, and you know, the idea is to take you from, okay, I now have this idea of how to make money with the business, and what are the first like 5, 6 things that I need to do in order to get myself up and running and get myself in a position that is as tax efficient as possible so that I'm not killing myself in taxes by creating this new venture. So that is coming. That's going to be the 74 days course, and I'll let you know when that's ready. But otherwise, that's all I got for this week. So I will catch you guys later.
Alrighty.